JEPI. Everybody keeps talking about JEPI, how you can retire on it, live off the dividends, and so on. I am here to tell you that this is wrong. You have been deceived. Okay, maybe that's a bit harsh, but most of the JEPI videos I've seen on YouTube are extremely misleading. Yes, misleading. We all know JEPI is JP Morgan's Equity Premium Income ETF. It was launched in May 2020. In 2022, JEPI was the 8th most bought ETF with $12.5 billion in fund inflows. And this year, it's gone up to 5th place with $11 billion of net inflows so far in 2023. As of the latest data, JEPI has $29.3 billion of assets under management. That's not bad. JEPI has returned 49.5% since its launch, which equals to about 14% annualized returns. That's a great performance, although the S&P 500 has returned close to 10% more than JEPI over the same period. In fact, if we look at only price returns, JEPI has done way worse than the S&P 500. That's actually not that big of an issue. JEPI is an income ETF. The strategy here is monthly passive income with some price returns. Naturally, JEPI is gonna lag behind large blended ETFs in terms of capital returns. So again, that's not really a problem, but to me, it looks like most retail investors do not realize what JEPI is meant to do. A lot of them say things like, buy JEPI, you'll get growth and a massive yield. I'm sorry to break it to you guys, but that's not how it works. JEPI has had a good run in the last 3 years. True. However, JEPI is focusing on buying low volatility value stocks in the S&P 500, then selling covered calls on these. The aim of this fund is to generate steady, incremental income while minimizing volatility. To do this, JEPI invests at least 80% of its assets in equity securities or stocks, and the other 20% go to ELNs, which are equity-linked notes. Essentially, they sell covered call options to generate the extra income. This means JEPI does get exposed to some capital returns, but because of the nature of the call options, those capital returns are limited. This brings me to one of the biggest problems with JEPI. A lot of investors see what JEPI has done so far and expect it to continue. It will not. We have seen annualized returns of 14% so far. Can we expect these in the future? Absolutely not. Even the managers behind JEPI expect 6 to 10% annual returns. Out of these, 1 or 2% come from dividends and roughly 5 to 8% come from selling options. The rest is the variable performance of the actual stocks in the portfolio. The investment goal of JEPI is to have more consistent, less volatile returns than the S&P 500. That's what JEPI has done so far. The ETF has returned 58% of the S&P 500's performance, but with only 67% of the volatility. What does this mean for the future of JEPI? It means that the ETF is sacrificing the high returns that S&P 500 can give you during bullish markets to avoid the big drops that can happen during bearish markets. In volatile sideways markets, JEPI will most likely do better than the S&P 500 because that's when selling call options is the most profitable. High volatility leads to higher option premiums. This is extremely important to understand for anyone who wants to invest in JEPI for the long term. JEPI is not meant to beat the S&P 500. Instead, JEPI can give you more steady annual returns, mainly through income distribution. That's why people who need a steady income to live off can definitely use it. It's also perfect for people in retirement. At this point, you're probably wondering, wait, didn't you say people were misleading us about retiring on JEPI and living off the dividends? You were right, yes, I did say it. The tricky part is this: if you are not yet in this position where you have enough capital to live off the dividends, going all in on JEPI is a bad idea. If you think JEPI will help you grow your portfolio faster, snowball your dividends faster, you are mistaken. People who say that have not read the prospectus. They have not seen the JEPI investment strategy or the risk involved. The S&P or even the Nasdaq 100 are much better at growing your capital over the long term. Once you get to the stage where you can actually live off your portfolio dividends, that's when you switch to JEPI. I'm talking $1 million in capital or more, obviously depending on where you live and your expenses. Let me show you the numbers here and why a lot of people get misled. Let's take the 14%, which a lot of people assume will continue to infinity. Let's say we invest $100 per month, reinvest the dividends and hold for 30 years. How much money are you gonna have at the end? $562,000. Wow, that's insane. No wonder people get excited. That's nice, but the best case scenario that the JEPI managers project is 10%, so let's take that instead. The result is 230,000, less than half. If we take a more likely scenario, somewhere in the middle of expectations, around 8%, we get 151,000. If we take the worst case scenario of 6%, the result is only $101,000. That's just 18% of the first estimation. Whenever you forecast performance, always make sure you look at the optimal and worst case scenarios. It can give you a lot of perspective. That way, you're also going to be able to spot the people who know what they're talking about. But even if we ignore that, there's also another issue. As we can see in this chart, the majority of JEPI's returns come from distributions and dividends. This creates another problem for investors: taxes. The problem I have with a lot of JEPI analysis is the part where they completely ignore taxes. You see people talking how you can add just $100 or $200 per month, reinvest the dividends, and then at some point you can live off of them. Let's ignore the fact that most of these also estimate that JEPI will continue to return more than 14% total annual gains. Where is the part where you pay taxes in these estimations? Yes, you can use a Roth IRA for some of your JEPI holdings, but the limit this year is up to $6,500. That's significantly less than what you need to invest to be able to live from dividends only. This means that a lot of your gains may actually be taxable. The problem with JEPI is that just 15 to 20% of dividends are qualified. What does this mean? It means that if you are a high-income investor, the effective JEPI tax rate could be close to 40% in taxable accounts. Here is another thing that a lot of people miss. If you want to live from your dividends before you have retired, then you cannot use a Roth IRA. Why? Because you can't access any of your earnings unless you're older than 59 or you have to pay taxes on them. This means in order to be able to live off dividends from JEPI, you will have to expose yourself to taxes, a lot of taxes. We saw that most of JEPI's returns are from dividends, roughly 80% of all returns since the ETF was launched. I'm not a tax accountant or advisor, but my point is that your income from JEPI can take a nasty tax hit. When you consider this, suddenly JEPI doesn't look that attractive anymore. If you live somewhere else, like in the UK, then you're lucky, because the limit for an ISA is £20,000, which equals to about $25,300. Plus, you can withdraw and use this money anytime, so if you want to live off your dividends this way, you can do it. The problem here is you will get slapped with a flat 15% withholding tax on dividends. This tax can get up to 30% depending on the country. Since 80% of JEPI's returns are dividends, that means you are going to get a lot less than what you expected. At this point, I know that I sound very negative about JEPI, but in reality, I'm not. JEPI can be a great choice, but many people have the wrong idea about this ETF. There absolutely is an investment case for JEPI. Like I mentioned, this ETF does really well in volatile markets. It's also meant to do better than the S&P in bearish markets, so you can get some JEPI as a hedge alongside some S&P 500 index fund like SPY or VOO. However, I don't think it should be the main core holding in a portfolio unless you are retired or close to retirement, or you have it in a tax-efficient account. If you're in your 20s like me, it makes very little sense to go all in on JEPI. Instead, simply buy the S&P 500 or a Total World Index Fund. They will almost definitely give you better returns than JEPI in the long run. So, that's what I have to say about JEPI. What do you think? Is it worth buying JEPI or are you not a fan? Let me know in the comments below. Thanks for watching and I'll see you again in the next one.